My name is Serkan Bahçeci. I'm the partner and head of research at Arjun Infrastructure Partners, a core-to-core plus mid-market manager focusing in Europe. I have been a dedicated infrastructure researcher since 2007. So one of the, let's not gonna say oldest, but one of the most experienced in the market. Infrastructure as an asset class is going through its first real test in terms of business cycles. The interest rates are up. The fourth-year interest rate cycle abruptly ended. And as an asset class, we are going through that for the first time. And it has a lot of lessons learned and implications for us. The very first lesson learned is on inflation protection, in my mind. We need to start looking at the expected returns or the performance on real terms, inflation-adjusted terms, rather than the nominal terms. It's essential for infrastructure. That's what it's supposed to be doing, so we should focus on it. The second lesson learned is on the valuation, the asset valuations and the discount rates. If you look at what's happening in the market today, the number of transactions, the level of transactions, the volume has declined, but the assets are keeping their values when we focus on a few transactions that happened. So there is real support in the market for the infrastructure assets keeping their valuations. At the same time, we know that the cost of capital has gone up, and it's not just for infrastructure, globally for every asset class out there. So the discount rates, either internally or externally, they have to go up, and they did go up. When any manager is looking at a new investment, the expected returns are now significantly higher, around 200 basis points on average, in my view. How do we explain that discrepancy if discount rates are going up that much and the values staying put? There is a bit of an visible or seemingly inconsistency there. And my explanation to that, once again, goes back to inflation. The inflation protecting assets, and not all infrastructure does that, that's a lesson learned, but for the inflation protecting assets, where the revenues and the costs are indexed and there is long-term fixed rate debt in place, we get a huge increase in the future cash flows just because of inflation. So that positive impact dominates the negative impact we are observing from the discount rates. And that's the reason why infrastructure assets are keeping their value while the expected returns are going